To the equities market in a short while, but let's recap the market for you. In particular, the FX market, bring that into the conversation. $2 billion was the total turnover at the investors and exporters window last week. Significant portion of that figure, $2 billion, was traded, but 99% of that was done within the 360 and 369 Naira-dollar relationship band. Or the rest of the transaction, just about 1% or less than that, was between 340 and 359 bracket. The foreign reserves declined a little bit further, less than $200 million in the week. But the forward FX market is where you may need to pay more attention to the forward pressure on the Naira against the dollar. Across all major dated contracts, 1 month FX transaction, the Naira lost 0.36% on the dollar. On the 3-month FX transactions, contract, the Naira was down 0.71%. On a 6-month FX contract, the Naira was down 0.90%. On a 1-year FX contract, the Naira was priced a negative 1.53%. That brings you, what does it mean? That means that in 1 year from now, the forward FX Naira will be bought at 409.74 against the US dollar in the next 365 days. That's what the FX contract. And that tells you what pressure is building on the Naira against the dollar, and we expect part of the conversation around that on Monday, Tuesday next week, when the MPC meets for the second to the last time in 2018. That's one big story before the Nigeria's central bank. That'll be a big story. Let's get a bit more sense into the falling stock market that we had last week. More than 600 billion. We've seen the numbers in the water. Eronmosele Aziba is one of the investment analysts and is live to us from Afrinvest, really. And is joining us from the stock exchange where our downtown studios is located. Eronmosele, good morning. It's good to have you on the show.
Good morning, boss, and thank you for having me.
Thank you. Last week was a falling knife, and we tried to hold it, and the knife got the markets, got our hands damaged. Yes or no?
Yes, essentially, we saw the markets continue to
don't get scared with my analogy.
Last week.
You seem scared, isn't it? About the falling knife.
Definitely not.
I'm sorry, don't mind me. I just felt maybe that was a good analogy, but it looks like you were scared about holding a falling knife. I don't have any expertise in that kind of
it's been quite
of game. Yes, yes. I don't know how to except juggling a few balls here and there. Holding a falling knife or holding a snake, a live snake, is not one of my pastime. I would watch it on National Geographic Channel. But again, let's talk about this on channels where this comes first. So, how did we arrive at this very massive downside, 5% in just 1 week?
Yes, I mean, last week as well, we recorded one of the single largest losses that has been recorded on a daily basis, about 3.5%. Last time we had that was about 8 months ago, thereabouts. So we've seen investors continue to sell off in the market, considering the generally bearish sentiment towards frontier markets on a global scale. And then streamlining this down to Nigeria, there have been a lot of concerns with regards to political uncertainty, which has also weighed on investor sentiment in the market. And I mean, looking at the performance of the economy, yes, GDP has remained positive. Macroeconomic indicators have remained quite strong. I mean, external reserves still at high levels owing to higher oil prices and increased production as well. But it seems like sentiment towards our markets still remains quite bearish. As we saw last week, we saw quite a number of market bellwethers who have sound fundamentals fall to year-low prices during the week as the sell-offs were sustained.
Eronmosele, what are investors scared of when we say the political environment? We're going to have an election next year in February. There's no doubt about that. Either the incumbent continues or we have a new set of economic managers in place depending on what the electorate decides at the polls. So it's going to be another morning after. Sun will shine, rain will fall by February next year. That's my prediction. I know that for sure. At least today it's going to rain, it's going to be sunshine. So why is this concern so much about the political circuit such that investors took almost 700 billion off the market street in just 1 week?
You know, from an investor's point of view, so with regards to the political environment here, now even going beyond the perception of the individual capacities of the individuals who will be running for office, the mere fact that there are uncertainties that still linger in the economy is one of the key things that has pressured investor sentiment, because the one thing that investors try to stay away from is uncertainty, which is a key deterrent to performance, and that is what we've seen play out in the market. There are still uncertainties as regards what the economic policy direction will be in the event of a continuation of the current administrator, or what policies we might see in the event that we have a new administration coming. So putting all this together have been the factors that investors have sort of been looking at, and currently there's still no clear direction as to what direction these could be going, which has also weighed on sentiment in the market. But I mean, if you recall back in 2015, we also, even though market performance was already dampened due to some other external factors, following the conclusion of the elections, we had a period of rally in the markets that was even popularly termed the Buhari rally thereabout. So it just showed that some sort of calm had returned to the market, and we expect that this could also happen following the conclusion of the elections next year.
Okay, if this is becoming a pattern of election comes, things go down. After the elections, we hit a takeoff button, or we go much into higher altitude. But again, this damage in the market, are there opportunities? Is there any silver lining despite this? Any rainbow somewhere?
Definitely. Like I mentioned earlier, last week we saw some of the market bellwethers touch year-low prices, and we saw that trigger some buy sentiment in the markets, even though sell pressures still lingered. So looking at stocks like the tier 1 banks, so the likes of GT, Zenith, Guarantee, and even Access, you can see that they're falling to significantly lower prices relative to historical trading patterns. And when you juxtapose this with their current performance in terms of their numbers, you can see that the current trading prices are not necessarily reflective of the fundamentals of these companies, and this is one of the reasons why we believe there are opportunities there in the market for investors to take advantage of. Although we recommend that for an investor who is coming into the market now, you have at least a minimum of a year's investment horizon. I mean, within this period, we expect that the political concerns should have significantly reduced. Then we might actually start to see investors trading based on the actual performance of these companies.
What's your take, you folks at Afrinvest? Are you guys adjusting your bull or best case scenario for the market, looking at this current very choppy nature of the stock market?
Well, I mean, as we get closer to the end of the year, we'll still be looking at projections. I mean, they were based on the projections we made were based on our expectations for the market, even though we view that investor sentiment could be largely weighed upon by the political uncertainties and the issues in the global market. We had a projection that suggested the market could close in the red, and we still believe that there's an opportunity that we might start to see some gains, possibly later in the year, even though this still remains largely speculative, as we believe that with the reduced prices that we've seen in the market, the current attractive valuation in the market could potentially spur some buying activity, which might somewhat lift market performance. But I mean, definitely, we don't expect to see the sort of gains that were recorded in the market last year or even earlier in the year.
Do you think the market is currently oversold? Do you think so?
Yes, I mean, looking at the market from a technical, from a technical analysis point of view, looking at relative strength index, for instance, which measures momentum in the market to sort of determine a period when market is oversold or when it's overbought. Market's RSI has remained below 30, which is in the oversold region, which continues to show that the market is currently in a position for a rebound, but that would be under normal circumstances. Now we have other external factors that are currently dampening market sentiment. But in terms of the performance that we're seeing in the market and pricing of some of the stocks, we can say that the market is somewhat oversold. I mean, even in terms of comparing performance of our pricing of our market relative to other African markets with a P ratio of about 15 times, which is significantly lower than an average of about 20 from other African markets, looking at South Africa, Egypt, Kenya, and the likes. It shows that even in this frontier market space, there's still there's pricing opportunity for investors to take advantage of.
What would you consider as a possible catalyst for this market, if likely, if anything, before the elections? Will there be a change of heart if the emerging markets route has hit the bottom, as some folks are saying on the global news channels this morning by analysts? Do you think this could be a fillip, there could be a tonic, as it were, for our market here?
Well, not necessarily. For us, any gains that we expect to see till the end of the year would largely be based on speculative trading. So investors just trying to come in to take quick advantage of the lower valuations that we're seeing in the market, and then maybe have like a week or 2 week investment horizon. But I mean, looking at it from point of view of the foreign players, even though we know there are concerns as regards stability in the polity, there are still some few foreign players who are still taking advantage of the pricing in the market. So purely on a pricing basis, in comparison to other emerging and frontier markets, we could see this somewhat trigger a positive sentiment in the market. But I mean, we still note that with the increasing adoption of hawkish monetary policy from developed, systemically important central banks, this could further spur capital flight from emerging markets.
Very interesting. Thank you very much. A very nice conversation with you, Eronmosele Aziba. Thank you very much, and have a very great week there on Market Street, one of the investment analysts at Afrinvest. Let's come back after the break. We've got trader money, then there is market money, then there is farmers' money. There's money for you, whatever you want. It's called money, money, money. Let's follow the money after the break.